Good morning, everybody, and welcome to the Q4 FY18 earnings conference call of Ujjivan Financial Services Limited. Representing Ujjivan Small Finance Bank, we have with us Mr. Samit Ghosh, MD and CEO, Mr. Qtr4 Davis, Chief Operating Officer, Mr. Rajat Singh, Head New Business Initiatives and Data Analytics, and Ms. Sneha Thakur, Head Collections and Credit of MFI Business. On behalf of Ujjivan Financial Services Limited, we have with us Ms. Sudha Suresh, MD and CEO, and recently appointed CFO and IR, Mr. Deepak Khaitan. First of all, I would like to congratulate the entire Ujjivan team for the strong Q4 results. I'll now request Mr. Ghosh to take us through the key financial highlights for the quarter, post which we will open the floor for Q&A session. Over to you, sir.
Thank you, Vikas. Good morning. Welcome to our fourth earnings call, and thank you for joining us. This year marks the first full year of banking operations for us. It has been a very challenging year, but it has been very satisfying that we've been able to successfully complete the year, showing great resilience in the face of the huge impact of demonetization, and at the same time, the agility to transform to a small finance bank. Despite the huge credit cost and the incremental operating cost of transformation, we closed the year in black, which was our goal, and we are very happy about that. Quarter by quarter, we have shown improvement on all parameters to achieve this goal. Battling the black swan event of demonetization was our first priority for the full year. We started the year where the entire MFI industry was struggling with demonetization losses. During this year, we focused on handling the demon losses and improving the quality of our loan book. We started with a PAR of 10% of the loan book. We've been able to reduce that to 4%. Our NNPA stands at 0.7%. We had estimated the one-time credit cost to be around 300 crores at the beginning of the year, and we were able to reach and close at 311 crores this year, and with a profit after tax of 7 crores. This has largely been achieved because of the collection effort put up by the entire microfinance team at the field, and the specialized collection units which we set up for the hard buckets and also for the recovery from write-off loans. The collection and recovery work will continue this year despite the fact that we have fully provided or written off the entire bad book from the demonetization. Our next priority was transforming to a small finance bank and building a strong foundation. This required us to build on the new technology infrastructure, new channels, branch banking outlets, handheld devices to take banking to the doorstep, biometric ATMs, phone, mobile, and internet banking. The third big challenge in terms of transforming to a bank was induction of a huge number of people from other banks and financial institutions, and training our existing staff to bring them up to the competencies of being a banker. We have also established new business lines and functions such as treasury, risk, compliance, etc. In technology, we have invested very heavily, taking technology to the customer's doorstep, paperless banking with our handheld devices. All our ATMs offer biometric, the authentication to provide customer convenience, especially for our customer segment. Our core banking system, Finacle CRM for unified platform, SAS for risk management, has been integrated with our legacy systems of BR.net for microfinance, SysArt for MSC and housing, and the Oracle account financial system. We extensively use the state-of-the-art payment systems provided by NPCI and the Aadhaar-based customer identification system. We have thus been able to set up a very strong IT infrastructure with the assistance of Wipro, who is our system coordinator. We are also building multiple channels to reach out to our customer and aiming these channels effectively as touch points for all our customers. We rolled out 187 banking outlets, which are bank branches and BC outlets, of which 47 are in unbanked rural centers as per our phased rollout plan. Our branches are customer-friendly, designed specifically to meet customer convenience and establish our brand. These branches are operating as full-fledged branches, providing services across all our asset products and also our liability base for our customers, both for our open market customers and our existing customers from the past, who were primarily microfinance customers. By the end of the current year, we plan to have 475 banking outlets across 24 states, thus building a strong base for our business growth. Biometric, ATM, handheld device, mobile banking, phone banking, and internet banking are multiple channels we are working on transitioning our customers from an interface which is largely been person-to-person or dependent on brick-and-mortar contact points. We started the year with a staff strength of over 10,000 staff with strict controls to close it at a minimum growth. So we closed around 11,242 staff. During the year, we recruited 3,500 employees, bringing in new skills required in the bank across the multiple businesses and functions, mainly in the area of sales, credit, operations, phone banking, audit, treasury, risk and compliance, legal and collection. On the people front, we have consistently ranked very high as one of the best places to work in the financial sector. This has helped us to attract the right kind of talent in our transition to becoming a bank. During the year, we have also reduced our cost of funds by about 140 basis points from 10.4% to 9%. We've repaid majority of our legacy by raising wholesale deposits at competitive rates. Retail deposits garnered by March 18 stood at 427 crores. We actually, given our preoccupation with the demonetization, resolving the credit problem and also transitioning to the bank, did not focus that much on building up the retail business, the retail deposit base. This was because we slowed down our banking outlet opening due to demonetization, and there were some operational and technical glitches in terms of onboarding all our microfinance customers. These have been all resolved, and we expect a robust growth in retail deposits and CASA balances this year. We have structured our operations to focus on retail liabilities, which will be the primary focus for the coming year. Branch banking team would target open market liability customers, and a separate team would focus on a specialized segments like tax, government, and corporate. Our business and disbursement growth during last year were 18.5% and 12.9% respectively over the previous year. Our overall portfolio stood at 7,560 crores, with the non-MFI portfolio contributing 7.3% of the total portfolio. While our microfinance portfolio continues to grow at 18 to 20% annually, the other business would drive the growth in our asset volumes in the future years. As a resilient organization and having built a strong foundation with almost all our existing microfinance branches converted to full-fledged banking branches, multiple channels and business lines in place, we expect that this current year will be our first year of takeoff as a small finance bank. And finally, I'd like to say a few words about Sudha. Sudha has been with us for over 10 years, and she's been a very close, we work very closely. She has decided for personal reasons to move on, and we respect that. But she's still with us till end of June, and I'm sure she'll be with us after that also, in whatever capacity. And with that, I'd like to hand over to Sudha to take you through further details and the financials. Thank you.
Thank you very much, sir. It's been my proud privilege to be part of building one of the finest microfinance institutions in the country. And it's, as sir said, for personal reasons that I would move. But truly, I believe I'm a part of Ujjivan already. So with that, let's move on to the quarter and the year's results. We have posted an excellent quarter across various parameters. Starting from our business disbursements, we have clocked the highest ever quarterly disbursement of around 2,262 crores, which is an impressive 61% year-on-year growth and 6% growth over the previous quarter. For the year, the disbursement stood at 8,052 crores, which is an increase of about 13% over the previous year. As of 31st March 2018, our gross loan book stands at 7,560 crores, a growth of 18.5% over March 2017 numbers. Despite being selective in new customer acquisition with the impact of demonetization, we have added 7.6 lakhs new borrowers during this fiscal year. During this quarter alone, we have added a record 2.2 lakhs new borrowers, thus closing at about 37.1 lakh borrowers as of March 18, vis-a-vis 35.7 lakh borrowers as of March 17. So the year also saw the share of MSE and affordable housing increasing to 7.3% of the portfolio from 2.4% at the start of this year on the back of very healthy growth in disbursements in the second half of the fiscal year 18. We expect a rapid growth in these two verticals, as sir had just mentioned, to add to the asset volumes in the coming period as well. Moving on to the financials of Ujjivan, net interest income of the banking operations for the quarter was at 271.2 crores, which was an increase of about 24.8% over the previous quarter. Consequently, net interest margin for the bank also increased to 12.8% in Q4 from 11.1% in Q3 FY18. Our funding cost has shown an overall reduction of 140 basis points this year as a result of prepayment of high-cost legacy loans and replacing them with an increasing deposit base, which have been acquired at comparatively lower costs. So during the year, we have actually repaid 4,353 crores of our legacy borrowing, and our average cost of funds, as indicated, has reduced to about 9% by end March 18. Coming on to our cost-to-income ratio, which stands at about 67.1% for financial year 18, and that obviously is much higher than the numbers we see for financial year 17, which stood at 53.8%. And these essentially reflect the increased cost of the transition towards the SFB. Our total credit cost for financial year 17-18 is about 310.8 crores, which is 4% of the portfolio, and this is almost in line with our earlier guidance. We have a provision coverage ratio of 81.5%, even after we have written off a sizable portion of 177 crores during the fiscal year. The GNPA has been trending downwards since its peak. As of December 2017, GNPA was at 4.2%, and this has further declined to 3.6% as of March 18. Our NNPA stands at 0.7% as of March 18, compared to the 1% as of December quarter. The portfolio at risk, which we call as PAR greater than 0, is 4%, and the GNPA or the PAR greater than 90 days stands at 3.6%. The difference of the two, which is 0.4%, indicates that the fresh delinquencies are very small and minuscule, as we have seen a consistent collection efficiency of 99.6%, on all the loans which we have disbursed since January 2017. Our net profit for Q4 was 64.9 crores, vis-a-vis, of course, a 29.3 crore in Q3 and 19.4 in Q4 of FY17. The ROA stood at 2.8%, vis-a-vis 1.3% of Q3 FY18 and 1% in Q4 FY17. The ROE for Q4 stood at 15%, vis-a-vis 7 at Q3 and 4.4% in Q4 FY17. Of course, there are certain elements which were extraordinary or a one-time element which can be discussed later. The capital adequacy ratio is at 23%. We would like to indicate that this computation of the capital adequacy ratio is as per RBI directive dated November 8, 2017, which provides exemption for all SFBs with no capital charge on market and operational risk-weighted assets. Moving on to the liability business, as indicated by Sir, we have good interest from the institutions for our deposits post our scheduled bank status in August 17. We were therefore able to garner a sizable institutional deposit, including CDs, during the year, and this was our strategy for the first year of our treasury operations. Our deposit base stood at 3,772 crores as of March 18. Our CASA ratio is at about 3.7%, and overall retail deposits stand at 11.3% of the total deposit base as of March 18. We have also witnessed good traction from retail deposits in the form of FDs and RDs, as our rates are quite attractive in the market. 73% of the retail base that we built is constituted of new-to-bank customers. We expect this retail deposit base to grow further in line with conversion of full-fledged banking outlets, as also mobilization of deposits through the existing customer base. Deposits cover 50% of advances in Q4 FY18 against 36% of Q3 FY18. Our board has recommended an equity dividend at the rate of 5% for financial year 17-18 out of our past reserves. In all, to conclude, we have built a strong foundation during FY18 and we are all set for the next phase of growth in the coming years, specifically in financial year 19 onwards. With this, I would like to hand over the session back to the moderator to start the question and answer session. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dhaval Gada from...
Hi ma'am, hello.
Sundaram Mutual Fund, please go ahead.
Hi ma'am. Many congratulations on superb numbers. Just 2 questions. First, on the microfinance disbursement, so we've seen pickup happening in this segment, but if I see on a monthly basis, on an average for the quarter is about close to 640 crores. This was similar run rate pre-demonetization quarter. So going forward, how do you see disbursement growth trends in the microfinance business, and any specific pockets of caution, or have we scaled back given the elections? Some color on the risk in the business that you're seeing, and also the growth trajectory that you envisage in this segment for FY19.
So first, let's clarify the growth that we're talking about for Q4 FY18. So we have seen disbursements in the microfinance business for about 1,910 crores during this Q4. The micro individual loan has been at 174 crores. And these have been significantly, about 56% up year on year if you would compute. And quarter on quarter, the microfinance loans, of course, are up 1.8% and the individual loans up 31.6%. So we are seeing a healthy trend in our growth across the MFI lending also. And as we have indicated, for the future, we are looking at an 18 to 20% growth in the microfinance book. Having said that, you have also raised a question on what are the concerns considering the current position, basically based on, back-to-back on the farm loan waivers, as also any other impacts. What we would like to indicate that, post-demonetization, we have, taken a very cautious approach where we looked at centers and branches where repayment and collection efficiencies have come back to normal, and therefore we have moved on in terms of allowing these branches to go ahead with their regular business as also acquiring new customers. Over a period throughout in the last 4 quarters, we have seen that most of the branches have come back to a state of normalcy, barring certain PAR-affected branches, and therefore the MFI business across these branches which are back on track is more or less normal. And we do expect that these businesses will ramp up in the current year, FY19. As far as the farm loan is concerned, we have also indicated earlier that we have not seen any kind of standalone impact on the collection efficiency, primarily because of 4 reasons. We have seen these farm loan manifestos coming across states like UP, Karnataka, Punjab and Maharashtra. But we have not seen in the last 1.5 years any kind of impact of the same on our portfolio, primarily because we have more of an urban and semi-urban portfolio, and also wherever we have the rural portfolio, our exposure to agri is quite insignificant.
Sure. Thanks. The second question was on the cost of funds. What percentage of or what quantum of borrowing that is getting repriced in FY19 for us, if you could give that?
Yeah. So as I said, we have already had a legacy borrowing of 64%, which we have repaid during the year. We expect that almost about the balance, 30% would get repaid during this year. And what will be left over is just around 400 crores, which constitutes a sub-debt and an NC and a couple of NCs.
Okay. Okay. And just lastly, ma'am, on the income breakdown, could you break the revenue from operations for between interest on advances, interest on investment, and the fee income, if you could do that? Like a bank structure.
Okay, Q4. So if you're looking specifically for a Q4 breakup, I think the total income was around 460.9 crores. And there was an income from securitization here as well as the PSLC income which came in. So I think net of that, the total income for the quarter was 419.9 crores. And the reflection, if you would ask on PAT, so we would say that 64.9 crores was the PAT for Q4. And of that, we have an income of securitization of about 10 crores there and 5 crores in terms of PSLC. The rest constitute the normal business profits.
And investment income was how much for the quarter? Income on investment, the SLR book?
5 crores.
Okay, fine. Many thanks and all the best. Thanks.
Thank you. The next question is from the line of Kunal Shah from Edelweiss. Please go ahead.
Yeah, firstly, in terms of the overall CASA traction, so that's been, I think, when we compare it with the other players, I think that's been pretty slow. So how should we read into this? Still, when we see the entire replacement that is happening through CDs?
So, as I mentioned in the introductory this thing, is that last year we primarily focused on raising wholesale funds, and we are and reduce our cost of operations. That was mainly because of our preoccupation with, the whole demonetization issue and transition to a bank. However, this year we will focus both on the retail deposit and also on building up our CASA volume. So this is the year in which you will see much higher growth in both the areas. So last year, really, we didn't focus on building up our retail deposits.
But any target which we have in mind in terms of where we want to take the retail to the total deposits as well as the CASA ratio?
Yeah, so we're looking at building up our retail deposits to about 25% of the total deposit piece.
From 11% as of now?
Yes, which is 11.3% as of now.
Okay. And secondly, if we just look at it in terms of maybe the rollout of the bank branches as well as the expansion, there is some biasness towards east, okay, wherein maybe the conversion in east has been much higher in terms of the bank branches as well as new branches, significant, almost 2/3 of those have been opened in east. So is it like maybe, is there anything to read into it? It is a strategy at top level in terms of getting more aggressive in East? How is it?
No. So, the thing is, you see, if you look at the demonetization impact last year, the East was relatively unscathed, So, obviously, in terms of prioritizing the branch conversions, we prioritize the bank branches in the East. But that does not indicate any kind of our bias, because we will convert all our bank branches, your microfinance branches into bank branches over this year. And it will be right across the country.
Okay, and in terms of adding on to the branches, so maybe out of 23, 16 were in East. So even in terms of the additions, it would be all across?
Actually, the additions were mainly in non-bank rural branches, where we are planning largely in the East and also in South in Tamil Nadu.
Okay. And lastly, in terms of the number of active customers, so despite this kind of a disbursements, there is no increase in the active customers. So is it because maybe the pool which was there in the write-off, we have knocked it off? How is it? Maybe because that's almost stable quarter on quarter.
Yeah, that's the main reason for.
So we have knocked off the return of accounts.
Yes, that is roughly about 1 lakh plus accounts.
Okay. And lastly, in terms of the secured book, where do we want to take it to in terms of our strategy 3 years down the line, be it SME and housing?
So, our long-term aim, let's say 3-year time is to build 1/3 of our business from non-microfinance portfolio. Out of that 33%, 25% business actually build book should be secured loan.
25 secured. Okay. Yeah. Thanks a lot.
Thank you. The next question is from the line of Anuj Gupta from Perfect Research. Please go ahead.
Good afternoon, sir. So the cost-to-income ratio.
Yeah, please go ahead.
Yes, sir. So the cost-to-income ratio of one of our competitor Bandhan Bank is almost half of ours. So could you please let us know at what levels can you see our cost-to-income ratio down to in the future?
Yeah. So, our cost-to-income ratio target number for 3 years down the line is close to 50%. And, given that two different structure of banks, probably it's uncomparable to Bandhan even though they are in microfinance. They have various regulatory advantages as a universal bank, so they can have slightly different numbers. So our target is 50%.
See, essentially the Bandhan Bank branches, so they had about almost 2,000 asset branches. There was no requirement for them to convert this into liability branches because of a special exemption that they had from RBI to continue these branches as asset branches. Now, that's the kind of exemption which the SFBs don't have. And therefore, in our strategy where we are looking at converting all our branches into full-fledged banking outlets, obviously there will be a difference in the cost structure.
And in addition to that, our PSL requirement is close to 75%, and for Bandhan that requirement is 40%. So they have larger portfolio to actually sell and earn money in terms of PSL income. So these advantages make them slightly different than us.
And sir, please could you throw some light on the risk management practices of us in the microfinance space, and how are they different from others?
We've invested a lot in risk management, and I don't know how we can differentiate with someone else, but there has been a huge emphasis after we converted to a bank in putting in systems for risk management in terms of KYC, AML, and automated systems, etc. Having systems of monitoring every time there are issues and taking it up. So we have we've invested very heavily, and we have an excellent team which looks after it.
On that front, I think also, like the second line of defense which any bank has, we have our own second line of defense, which is the risk department, and the third line of defense, which is the audit department. So the functions are all well stretched out and well planned as any other institution, any other normal banking institution.
We also had an excellent track record as far as risk and compliance was concerned, even from our MFI days, and that tradition continues.
Just to add to that, our approach has always been very specific to the branch and the challenges and issues we face at the branch level. And our credit policies are also very specific to those clusters and branches, and that definitely differentiates us from the other players in this space.
Okay. Thank you. Thanks a lot.
Thank you. The next question is from the line of Shweta Daptardar from Prabhudas Lilladher. Please go ahead.
Good afternoon, team. Congratulations on good set of numbers. I have two questions. One is, so you mentioned in your opening remarks that entire demo pertaining book is written off. So the write-off number which stands at 45 crores today, which was apparently 34 crores a quarter ago, should downtrend phenomenally from next quarter onwards?
I didn't say entirely we have written off. We have written off and provided. And Sneh, I think you can give a breakdown.
So the total credit cost for the year is 310.8 crores, and of which 177 crores is the write-off. The balance is the NPA provisioning that we are carrying right now.
So any guidance next quarter onwards?
In terms of write-off?
Yes.
So since we already have a coverage ratio of 82%, we may be looking at prudential write-offs from this bucket, depending on the recovery progress we see in the following.
Sure. So just related question. So on the traction on hard bucket overdue, so this number today stands at 32%. Last quarter it was 34%. Not a huge difference, but would you like to dwell more on this?
If you look at the whole year in totality, we are clogging an average of 34% tractions, and there will be some plus and minuses every quarter. But if you look at it in absolute terms, our reductions during Q4 have been higher by 7 crores when compared to Q3. And small drop in tractions of 2% may be on account of higher allocations to the dedicated collection team.
Sure. So one last question. So the new business collection efficiency is at 99.6%. It's impeccable, but it holds true with most of the industry players. So is it more of a market phenomena, or if you would like to elaborate there?
Sorry, more of what?
Whether it's an industry phenomena. Yeah, it's more of a reflection of microfinance industry coming back to normal.
The industry has revived, and that will be the trend seen across all players.
Sure, that helps. Thank you.
Thank you. The next question is from the line of Manish Oswal from Nirmal Bang. Please go ahead.
Hello.
Hello.
Hello. Hello.
Yeah, please go ahead.
Yes, sir. My question on operating expenses growth in this quarter. Looking to the branch addition in the quarter and the pace of operating expenses, there is some misconnect, or can you explain that why the operating expenses growth is quite muted despite of so much branches we added during the quarter?
So basically during this quarter, we did have a number of branches getting opened, but many of them were URCs, and typically these have a very low cost impact. And therefore, more or less, you have seen the operating expenses being flat in this quarter or just marginally up over the earlier quarter. And probably the basic impact is because of the many number of URCs which are opened in this quarter.
Okay. Secondly, at the beginning of the year, we gave guidance of credit cost of 300 crores. Now, we have coverage of 81%, and mostly the portfolio at risk also at 0 days is 4% and 90 days 3.6%. So how do you see the credit cost for next year? It will be less than 1% of the portfolio, or how do you see that number?
We expect our GNPA to be less than 2% and our NNPA to be in the range of 0.75 or even lower than that.
And credit cost, ma'am?
Total credit cost will be in the range of 0.3 to 0.5%.
And second question to Mr. Ghosh, what is the succession planning at the top level, sir?
So our board has already put in place, the whole process of successor, to identify the successor both from our internal and talent pool and also external, And the plan is basically that I would retire in November 2019. So whoever is going to take over as a successor would have at least a year's transition with me.
Okay, and last question.
The process is already in place. It's already...
So there should not be any hiccups on that process, right, sir?
There should not be any hiccups because it's already in the processes. The board has already put the process in place.
Right.
In terms of identifying a person to take over.
And
we have a large internal talent pool, and we'll also benchmark with external people and see whoever is the best. The board will obviously choose that person, and that person should have at least a 1 year overlap with me, given the fact that I'm going to retire in end of November 2019.
Right. And secondly, in terms of operating expenses growth for next year, FY19, what rate one should assume? Currently, it's 654 crores for full year.
Rajat wants to know about operating expenses.
Could you please repeat your question?
Sir, this year we end up the operating expenses at 654 crores, which is bang on your guidance. Now, what is your outlook for next year, given the significant pace of banking branches setup?
Sure. So in previous guidance, whenever we have given, we always maintain that the whole branch banking transition will be done in 3 years' time. And basis our experience and early resolution of all the demonetization related problems, we have revised that plan, and bulk of branches which we are planning to open in this financial year itself. So rather than stretching our expansion for 3 years, now we are doing it in this financial year largely. That has some implication on our cost to income ratio, and cost to income ratio may be higher by 3-4% in coming financial year.
Compared to FY18 level, right?
Yes.
Okay, and...
Manish, I'm sorry to interrupt, but may I request you to come back in queue for follow-up questions? Participants, in order to ensure that the management is able to address questions from all participants, you are requested to limit your questions to 2 per participant. The next question is from the line of Shripal Doshi from Equirus Securities. Please go ahead.
Sir, thanks for the opportunity. Rohan here. So could you share your average cost of deposits and incremental cost of deposits?
Incremental cost of deposit will be closer to 7.5%. Average cost of deposit may be closer to 8%.
And sir, how is the movement of NPA for the full year? Additions during the year and recoveries upgrades write-off?
During the quarter, we opened at 294 crores and we saw an addition of 55 crores, a reduction of 38 crores and write-off of 45 crores. So from this addition of 55 crores, 40 is on account of closure of securitization deals. So in total, Q4 has seen the highest reduction. And we closed at 275.
And ma'am, from earlier question, one of the participants had asked, there was a reduction of close to around 6.2 lakh borrowers that left Ujjivan relationship during FY18. So just want to get a color, like what percent, how would the split between the delinquent borrowers leaving and what was the split of the regular borrowers? And the regular borrowers who left us, whom did they go ahead and borrow from? Or was it that they did not borrow after closing a loan with Ujjivan? So if you could share some...
Traditionally, if you look at our customer retention ratio has always been in range of 85 to 90%. So there is always this 10% of customer base who kind of do not come back to us due to various reasons. Out of that 10%, majority of them don't come back to us because they already have more than 2 loans and we have to reject them during the credit appraisal process. But there are set of customers who sometimes take a break and sometimes delay the next loan or go to other competitor. So I would say majority of those customers who have left us have left us because of the bureau rejection from our end.
Okay. Fine, sir. Thanks a lot.
Thank you. The next question is from the line of Saral Sheth from Karvi Stock Broking. Please go ahead.
Yeah, so just if you could highlight a normalized cost-to-income ratio for FY19 and 20, which could help us understand.
Yeah, just I was mentioning in previous answer, our cost-to-income ratio for FY19 will be in range of 70 plus or minus range. And going forward, that number could be closer to between 60 to 65 or 20.
Could you just mention the reason for a high cost-to-income ratio compared to other banks? If you could just throw some color and what measures could be taken to reduce this cost-to-income ratio to a sustainable level?
Sure.
In the longer run, sir?
So bulk of this increased cost-to-income ratio is coming because of high investment cost in infrastructure of rolling out branches and the technology. These are most of these costs are one-time cost, and we will leverage as we start expanding our businesses in coming years. So that is one reason. And if you look at other SFBs who are in transition, their cost-to-income ratio is also quite high and showing an increasing trend. It's a function of when a bank has gone live and how long they are in working as an SFB. So if you look at our competitors, they are also having very high cost-to-income ratio. Somebody just mentioned about Bandhan. So Bandhan cost-to-income ratio is lower because of various reasons, starting from their regulatory advantages which they enjoy. Plus, from a vintage point of view, they are almost 1.5 to 2 years older than us as a bank. So for them, those investment cycles are already been done.
Okay.
These numbers will come down as we start expanding and leveraging the investment which we have made.
Okay. Okay. Thanks, sir. Thanks. Thank you.
Thank you. The next question is from the line of Sangam Iyer from Shubhkam Ventures. Please go ahead.
Hi, sir. Sir, just wanted to clarify. I just missed on the cost-to-income target that we have for the next financial year.
Yeah. 70%. It's a number which we are quoted is 70%.
70%. Okay. Got it. Thank you very much, sir.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hi, good afternoon. 2 questions here. One is on the MFI business. Samit, sir, if you could just kind of broadly explain the broad rationale for why we are seeing the increase in the upper limit from 60,000 rupees to 80,000 rupees. Does it really make an impact? Second, on the MFI business that we have seen, we have now started to see more and more individual products being introduced to this customer segment. When the rating happens on the borrower, we just are not sure as to whether the credit information bureaus give you the report of both the MFI outstanding as well as the individual loan outstanding that they have. Just wanted to get your feedback on these 2 points. And also, if you could also give us product-wise NPLs between MFI and non-MFI, that would be great, sir. Thanks.
Okay. Sneh, you want to answer this credit bureau?
Yeah, so I'll take up the credit bureau question. The credit bureaus, especially Highmark and CRIF, have come up with a combo report wherein they provide the borrowers MFI as well as retail bureau information together. And we will be using these reports starting from next month onwards. So that's already in place.
And have you been able to analyze this?
Loan limit, I think earlier MFIN had a loan limit of 60,000, which since RBI permits the loan limits to go up to about 100,000, they have increased the loan limit to 80,000, I think, this year. So as a bank, we overall loan limits we have been looking at, and we've been this largely following what Bandhan has been doing in the past because they became a bank first. They have been looking at loan limits of 100,000, overall loan limits of 100,000. And that is actually what we'll be looking at. In terms of micro lending, we are around 80,000 or 75,000. Group loans, we still actually on our average is still about 27,000.
So when you talk about loan limits, 80,000 is not the limit. It is the indebtedness cap of the borrower. Our ticket sizes on group loans continue to be within 50,000, and clusters and states which are performing exceptionally well, we have an indebtedness cap of 100,000, and affected clusters, based on our understanding of the situation, we are revising it from 60,000 to 80,000. It is not the loan limit, it is the indebtedness cap of the borrower.
That's ma'am, the reason I asked this question is that just trying to understand the broad rationale for that move, given that most the MFI borrowers are, the average ticket size is around the range of 25 to, probably a disbursement is probably at around 35,000 rupees. Just trying to understand whether it's really required for the industry to take the step from 60 to 80.
So even our average ticket sizes are in the same range of 27,000 to 28,000. It is only that the cap has been increased because there is need for the borrower, else we are seeing that they are borrowing from informal lenders even after borrowing from institutions. So since we have a cutoff of 60,000, we end up giving them a lower ticket size if they are approaching as the second or the third institution. And they will have to go back to the informal lender if we cut it off at 60.
Fair. And the product-wise NPLs?
See, GNPA for all other products are at this moment less than 1% except microfinance and individual. So okay. It's pretty much lower than 1%.
No, I just thought, is it useful for us to start reporting this data?
Sure, we could do that.
Okay, thanks a lot.
Thank you. The next question is from the line of Rahul Ranade from Goldman Sachs Asset Management. Please go ahead.
Yeah, hi. Just one quick question. So, are we seeing any unfavorable impact of the elections, kind of early days, but are we seeing it anywhere on the operations or on the asset quality in Karnataka?
I don't know. I took my voter's registration card and found my card was invalid. Okay, that's beside the point. No, we are not seeing anything so far. And, I think it's premature to all this, as we said, as far as microfinance industry is concerned, elections or loan waivers rarely have impact on their portfolio. As far as Ujjivan is concerned, in Karnataka, bulk of our portfolio is actually urban, semi-urban. Bulk of our customers are there. We have a very small portion in the rural area in terms of agri lending. So even if it comes through, I don't think there'll be any significant impact. But overall, we are not seeing anything. Even during demonetization, I must highlight to you that in Karnataka, it was the rural portfolio which stood up, which was good. It was the urban portfolio which actually got affected. So we don't see an issue here.
Sure. And just a clarification on the earlier answer. So we are following a 100,000 rupees limit instead of the 60 or now revised 80,000 per borrower.
Yeah, we have actually 100,000 overall customer borrowing cap. That's what we look at. But based on our experience, depending on particular area, we set a different cap. That's what I think Sneh was mentioning.
Today we have 60 and 100,000, and we are considering moving up to 80 in clusters which have performed better over the last few months.
So we have 100, 80, which we are going to implement, and 60 where, the portfolio quality has, in the past 1 year, has not been very good.
Yeah, underlying all this, you have to understand that we have a dynamic process. So it is a reaction to market, and it's always built in that process.
Sure. Yeah. All right. Yeah. Thank you.
Thank you. Due to time constraints, participants are requested to limit their questions to one per participant. The next question is from the line of Digant Haria from Antique Stock Broking. Please go ahead.
Hi. So what would be the yields on our non-microfinance business? So majorly this housing and the MSE portfolio, which we are, planning to accelerate in the next 2 years.
So yield for our housing portfolio, weighted average would be close to 14%. For MSE, that number will be closer to 18 to 20%.
Okay, and this MSE portfolio is a secured portfolio, right? This 18 to 20%, or
it's a combination of secured and unsecured. Our targeted aim is 1/3 of our portfolio to be unsecured, 2/3 to be secured.
Okay. All right. Thank you.
Thank you. The next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi, sir. Sir, just on this off-balance sheet number, which has now become close to 0% as a share of AUM. So how should we look at this number, considering, is it that, the off-balance sheet securitization is now more preferred versus through PSL route, or how should we look at this?
Yeah, so we had a close of quite a few securitization transactions in the last quarter. And with that, the impact has come where you see your net loan book equivalent to your gross loan book. And going forward, definitely, yes, we will not be having securitization transactions. And we do have in the banking structure, we have recourse to the PSLC, which has come through, in fact, even in the last year.
So incrementally focus would be more towards PSLC versus, let's say, securitization, is it?
Yes, absolutely. We will not have securitization transactions in future.
Sure. And just one more question for sir. Sir, would you be open for, after your term ends, would you be open for, let's say, non-executive chairman post, or any thought process there?
I don't know. I mean, after I retire, not in the bank, but maybe in the holding company.
Sure, sir. Thanks very much.
Thank you. The next question is from the line of Alok Shah from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. Sir, I just had a question around growth. Did I miss out on that? I mean, what's the kind of growth that we're looking on our MFI and the non-MFI portfolio? And on the same lines, when we talked about provision cost at 50 basis points, would that mean that you're talking about a sharp drop in overall credit cost for 19?
Okay. So what we are looking at is an overall 30 to 35% CAGR growth year on year on the total portfolio. And if you would like to, see the breakup between MFI and others, what we could indicate is that MFI book will be steadily growing at around 18 to 20%. And the affordable housing and MSE, which have larger ticket size and therefore would contribute significantly to the, asset number in the portfolio breakup, they would be growing, ramping up much faster.
And on the credit cost there, if we kind of take up these numbers and then a 50 basis points credit cost, then that would translate into a significant drop in overall credit cost for 19. Now of the 300...
We do expect a significant drop in the credit cost because as you see, the number was inflated predominantly due to the demand effect in the last year.
But that's 177 crores of provisions towards write-off accounts. There's still a balance of 130 crores which is there towards the NPAs, right?
So we have indicated that we have provisions against it, which will be utilized for further write-off during the year.
So on that line, does it mean that with 2% GNP and 0.75% net NPA, that would translate into a PCR of 60 to 63%? So is that what we're looking to do from an 81% PCR to 62% PCR?
So I don't think that would materialize because you could have the net NPA is much lower than that.
Okay, because you talked about 2% GNP, 0.75% net NPA.
Yeah, so sub 2% because at this juncture we're just out of the shocks of demonetization, so we're still conservative with our book.
And also as the other non-MFI portfolio ramps up, provisioning norms there slightly different than the microfinance one.
Sure, and just one thing, how do we look at PAR 90 and PAR 0 portfolio moving closer to a steady state number in quarters to come? And the journey is...
May I answer that?
So, like we told you, GNPA is going to be less than 2%. Presently, that itself is a par greater than 90 days, which is at 3.6%. So, in our estimate, this is going to be sub 2% next year.
Fair. Thank you. That's kind of.
Thank you. The next question is from the line of S. Parmeshwar from JM Financial. Please go ahead.
Yeah, hello. Congratulations, sir and team, for a great set of numbers. Sir, on the ticket sizes, so we are at around 27,000 on group loans. So, till how much do you see is the headroom? Till what levels are we comfortable over here? And secondly, what is the average cycle of our customer base in the group loans?
Average cycle is over 18 months, no? Yeah. And in terms of loan sizes, what are we looking at?
There could be, we could see a 10% growth in our ticket sizes during the year.
Okay. And sir, the average cycle of a customer base, say, compared to the rest of the industry, how many cycles deeper are our customers?
Okay. So no, I mean, I think his question, more than 60% of our customers will be more beyond 2 years. Yeah. And maybe 30% could be in range of 1 to 2 years.
Okay.
Up to 2 years.
Okay. And so what is your margin guidance for 19 and 20?
Our NIMs will be more or less flat. Whatever number we are seeing will be, this year we have reported will be more or less in the same range.
Okay. This quarter we have seen a very high uptick.
Yeah, so this quarter, as we had explained earlier, is an exception, but overall the guidance that we see, our NIMs would be more or less at the same range that we have for FY18. But over the next couple of years, as we ramp up our growth and profitability numbers, you could see a slightly more positive number.
Okay. Thank you, sir.
Thank you. The next question is from the line of Tushar Sarda from Athena Investments. Please go ahead.
Thanks. My questions have been answered.
Thank you. The next question is from the line of Dhavalkara from Sundaram Mutual Fund. Please go ahead.
Yeah, just one follow-up, ma'am. Could you give the risk-weighted assets number and also comment on, since the growth guidance has been accelerated, when do you think we'll need capital again?
Okay, so definitely on the question of capital raise, we would not be requiring capital for FY19. And even for FY20, we are largely funded because there's a huge chunk of Tier 2 capital which has been untapped yet and which we can tap in the current year and the next year. But looking at that, I think calendar year 20 could be the likely year where we will look at raising capital again.
Risk-weighted asset is close to 6,600 crores. That also includes extra charge on portfolio created through grandfathered loan.
Okay. Okay. And that will unwind as the borrowings get repaid?
Right. So, I mean, remaining 37% of borrowing, as they come down, this weight will also come down.
Sure. Thanks.
Thank you. The next question is from the line of Devang Maheshwari from Purnartha Investment Advisors. Please go ahead.
Hello. Thanks for the opportunity. I just missed upon the average tenure. So, can you just repeat it once?
The average tenure is about 15 months.
15 months overall?
Yes. So, for the microfinance.
Yeah. For MFI and for non-MFI?
For the MFI.
So, I mean, for secured loan, it could range in terms of secured, it will be close to 5 years. Unsecured, non-MFI could be 18 to 24 months.
24 months. Okay. And in terms of the branches, earlier it was like there was 149 branches which were having PAR greater than 5% that were not lending to the new customers. So, what's the status around there?
So, presently we have 127 branches which are over 5%. And across these branches, we are resurveying the operating areas to demarcate them. And in absolutely good areas, we will resume business this year.
So, what's the going forward target? Like in next 2 or 3 quarters, all these branches will be lending to new customers in that way?
Yes. Areas that we identify to be good, where the customer behavior is back to normal, the disciplines are in place, we will resume business.
So we have taken a slightly different approach this year. Last year, we had a ban at the branch level itself. So any branch which has more than 5% par, and because problem was quite new, at branch level we said there won't be any new customer acquisition. Now that things have settled down, we are going within branch also at the area level. And every area we are evaluating, and based on the potential risk appetite and overall scenario at the ground, we will open new customer acquisition in particular branch, in particular areas, not at the branch.
Okay, fine. And the average ticket size for Q4?
The average ticket size for Q4, for group loan it is about 29,000, for individual loan at around 78,000, for MSE at about 3.8 lakhs, and for affordable housing at 7.2 lakhs.
Okay, and in terms...
Devang, I'm sorry to interrupt, but may I request you to come back in queue for follow-up questions? The next question is from the line of Sohani Doshi from Edelweiss. Please go ahead.
Congratulations, team, for the good set of numbers. My question is, on a sustainable basis, with the product mix which we are having of 1/3 non-MFI and 2/3 MFI, so 3 years down the line, what kind of sustainable ROA, ROE are we targeting?
So overall, we are expecting, ROAs to stabilize at around 2.5, and ROEs could be somewhere around 17 to 18%.
Okay. And what level of gearing can we go to maximum?
So we are looking ideally at around 6 to 6.5 times.
6 to 6. But as per regulations, can you go higher than that? Say, like 10 or...
No, so we may not. So more than the regulations, it is actually the mix that we would like to see for the organization, which is backed by risk taking ability. And since we are also planning to go ahead with the capital raise in calendar year 20, I think at all points of time we keep our gearing reasonable.
Okay. Thank you so much.
Thank you. The next question is from the line of Manish Oswal from Nirmal Bang. Please go ahead.
Thank you. My question has been answered.
Thank you. The next question is from the line of Shripal Doshi from Equirus Securities. Please go ahead.
Sir, thanks for the chance. What will be the sourcing strategy right now on the affordable housing and the MSE piece?
Can you repeat your question, please?
What are the sourcing strategy that we are using on the affordable housing and the MSE piece right now to get new customers?
Affordable housing has various strategies. They have tie-up with builders, they have connectors, and they have also direct sales in the areas, So it is, connectors, builders. Then we are also advertising in the areas where new construction is coming up and using our phone banking to, solicit customers. Then we are also conducting micro-marketing activities around areas where new buildings are coming up. So these are multiple, approaches which these people are taking up.
So just to add to that, we have two predominant products. One is loan for self-employed, self-construction loan, and another is loan for outright purchase. So for self-construction, we are doing a lot of micro-marketing event in the catchment area, advertisement, as well as taking help of call centers. These things are done directly by our field team. In addition to that, we also have tied up with connectors in key market, and they are also providing us leads. For the outright purchase, we are tying up with various builders who are into the project of affordable housing. So that is giving us leads.
So what kind of an overlap would be there between, say, our existing customers and the new affordable housing customers? Would that be less than 10%? Would that be fair assumption?
Referrals from our existing customers?
Referral or overlap, like existing, somebody who would have interacted with Ujjivan earlier taking an affordable housing loan right now?
Around 10%. 10%,
okay. Thanks a lot, sir.
Thank you. Due to time constraints, that was the last question. I now hand the conference over to the management for their closing comments.
So we thank all the participants for their interest in Ujjivan and, putting across questions across various parameters. And we would also, expect that continued interest remains in Ujjivan as we ramp up our growth in the current financial year. And we would like to thank all other teams for the call. Thank you.